Let's connect with Anand Shah, Chief Investment Officer at BNP Paribas Mutual Fund. He joins us from Hong Kong. Anand, morning. Thank you for joining us. Anand, at the current juncture, are you a India bull or are you a India bear?
I think through the calendar year 2011, we were little cautious. We were seeing things like slowdown in policy making, slowdown in infrastructure investments, high interest rates hurting consumption to some extent, and very clearly the March quarter GDP number which came last week really reflected every concern which we had. From here on, if you ask me, I'm more positive on Indian equities. We believe the macro concerns in India are largely to do with slowdown in GDP and high oil prices. Both are receding. We believe oil prices, given what's happening in the macro economy, might remain soft, and incrementally on the policy making, we are seeing some reforms taking place, helping the GDP growth rate going forward.
Right, and where do you see India by 2012 end? At the brink of a rally with all bad news out of the way, or a consolidation with a negative bias given the long-term and sustainable solutions at this point?
Equity markets have been an interplay of the domestic story of India and what's happening around in Europe and US, and leading to that the risk on risk off environment. So India, being part of the emerging markets, has been playing out extremely well when there is a risk on, and it's also taking it on chin when the environment is of risk off. So I talked about environment or the macro economy getting better, but equity markets might take a little longer given there is a risk off environment which is going on, leading to some sort of softness in the emerging markets in general and India in particular. But overall, for the second half, as oil price, if they remain low as they are today and they continue to remain softer, and if there are certain reforms which will take up and help the GDP growth rate from as low as 5.3% to go back to 6-7%, I think the markets will look up rather than down in the second half.
Anand, a quarter ago you were bullish on consumers, private banks and some telecom stocks. Are you still bullish on the same group of stocks?
I think India is very clearly 2 to 3 parts of the story, which is consumption, infrastructure and exports oriented industries, and consumption has been doing extremely well for last couple of years. Even in the calendar year 2011, when Indian markets were not doing very well, the consumption space continued to do well. We still like that space. The India demographic story and a rising per capita income is helping that space. Infrastructure is something we remain negative, and still we believe it is some time away before it will bottom out. What is very recently we believe will start looking up is also the export oriented companies, because of the significant rupee depreciation. They will benefit in terms of higher realizations for their exports and more competitive vis-a-vis companies out there in US and China.
In the banking space, Anand, do you still favor large private banks, or do you like some of the mid-sized private banks as well?
No, we like the private bank space at large. In India, they've been gaining market share for last decade, and I believe they'll continue to gain market share from state-owned banks. That's a trend very clearly. However, for private sector banks, again, the competition has become very tough, given there are so many more private banks than they used to be a decade back. And very clearly, the large private sector banks have an edge over the mid-sized private sector banks, and that's why we do own a couple of mid-sized private sector banks, but otherwise our largest weightage is in the large private sector banks.
What are your thoughts on PSU banks or state-owned banks? They are attractive, but yes, NPA concerns are also quite evident.
State-owned banks have a significant reach in the interiors, and very clearly there are, I cannot say about all the state-owned banks, but there are quite a few well-managed state-owned banks which have a very nice liability franchise. There are issues in terms of non-performing assets within the state-owned banks, but as you rightly said, the valuations now more than reflect those concerns. So we are started looking very closely on a select few state-owned banks where we believe management is strong, liability franchise is strong, fundamentals are intact, and the non-performing assets are priced in. So yes, we have started looking to pick few state-owned banks.
And what's your view on telecoms, especially post the new spectrum pricing suggestions? Is the sector still attractive?
If you ask me, this is one of the largest consumer stories for the country as well as globally. For one of the largest telecom company in the country, they would have subscriber base of something like 213 million subscribers. So to me personally, it's one of the largest consumer stories in the country, doing very well. They're growing extremely well. What's not working in their favor has been a falling price because of a stiff competition. I think that phase of stiff competition leading to falling prices is behind us. Pricing seems to have bottomed out and actually started moving up. So average revenue per minute for these mobile companies has been started looking up for last 3-4 quarters. So that's positive. However, what's been negative of late has been the regulatory uncertainty. I think in an uncertain regulatory environment, the incumbents would actually benefit vis-a-vis the newcomers, and to that extent we continue to have our overweight positions with the incumbents, and we like that story very clearly. We have long-term positive despite of short-term uncertainty because of the regulatory reasons.
Anand, how would you dissect consumer names? Yes, consumer names have good growth momentum, strong return on equity, but what about valuations? Most of the A-quality consumer names are trading at stretched P multiples.
Yeah, it's a very tricky situation. They've been growing earnings. The volume growth is very nice, so they ain't disappointing you on the earnings growth. And to that extent, markets have rewarded them. Valuations have been steep. So selectively, what we have done is we have reduced our exposure in select few companies where the valuations become extremely steep, and they're too far fetched for us to continue holding them. However, in large consumers companies where the valuations are still within reach and they aren't very expensive, we continue to own them, continue to hold them, given a very strong fundamental backdrop of growing volume, growing pricing power, and growing margins.
Anand, are you increasing cash levels in the last month or so, given the Greece elections being the next event risk and what we're seeing in world markets as well as Europe?
Very clearly, we ain't taking too many cash calls, and more so now with the falling oil prices, we clearly see investment opportunities, because through the last year we had companies which got hurt because of the rising commodity prices. They are the same companies which will actually benefit from the falling commodity prices. We have seen sell-off in oil, sell-off in metals, sell-off in actually soft commodities like cotton, and we see many investment opportunities who will actually benefit from these falling commodity prices, and to that extent we have enough investment opportunities to deploy cash if at all there is any to be released from the risk of sell-off.
And also with a lower 6.5% GDP in FY12 and sub 7% in FY13, is India still lucrative a market for FIIs, or do you think the growth slowdown is going to sort of, stop the impetus on that?
I think fair enough. The GDP data has been very bad, particularly for the Q4. It was as low as 5.3%. But please keep in mind there is a lag indicator, and it surprised many market participants, but we were not the one who really got surprised with such a bad number. We were seeing all the problems related to high commodity prices, high interest rates, slowdown in policy making, all going to hurt GDP sooner or later, and it happened. I think if you look forward, and that is what an equity investor would ideally do, the falling oil prices and falling commodity prices in general is actually a big positive. If you compare with any other emerging markets, India's composition of GDP is more consumption driven. It's more and less inclined to commodities, and to that extent India will be one of the biggest beneficiary among the emerging markets because of the falling commodity prices. And I would actually now look, and so much so even the foreign institutional investors will look positively towards Indian equity markets from here, and given the valuation premium at which India is to trade has also fallen off significantly.
Finally, Anand, what about rupee? Closer to 56.5, closer to 56. Do you think rupee is now nearing an end of its decline?
Before we talk about, let's also understand that rupee depreciation is a part of a solution and not a problem. Very clearly, India has a large trade deficit, and to correct that trade deficit, we need to increase exports, reduce imports, and that's what exactly would happen given the rupee has depreciated significantly. So a correction was overdue, and that's happened. India's inflation is almost 700 to 800 basis points higher than the developed world, and to that extent that this correction was due and it has happened. I believe from here on the risks related to the currency would be more in general for all emerging markets and not only India. So India's standalone correction is behind us. Now if at all India's currency were to play out, it will play out in conjunction with every other emerging market currencies because of whatever is happening globally rather than something that's happening in India.